What's going on, guys? In this video, I'm going to go over how to recognize the trend, how to use Fibonacci retracements and extensions, and also introduce you to harmonic patterns. So the first thing we need to know is exactly what a trend is. There are two types of trend, an uptrend and a downtrend. So the definition of an uptrend is when price forms higher lows and higher highs. And that's going to look something like this, where you see price forming the higher high, a higher low, a higher high, and a higher low over and over and over until it doesn't and it forms into a downtrend. So a downtrend is the exact opposite. That's when price forms a lower low and lower highs. And it's going to look something like this. So we can see that lightning bolt formation going on. So with that said, let's look at on a real chart. So here, starting on the left side, HH means higher high, HL means higher low, and so on and so on. LH means lower high. So we can see how it goes right here. We can see price starts in a downtrend and then moves into an uptrend. So we can see right at the bottom where it actually transitions from a downtrend to an uptrend. This is important to know when using Fibonacci retracements and extensions so that we know which impulses and corrections to measure. General rule of thumb for trading: do not buy during a downtrend and do not sell during an uptrend. Pretty straightforward. We want the odds to be in our favor as much as possible. So if you're buying when price is tanking or selling when price is rising, you're putting the odds against you. So let's just keep it simple. Only buy during an uptrend and only sell during a downtrend. So that's how you recognize the trend. Super, super easy. So let's get into Fibonacci. Fibonacci ain't bocce. And what I mean by that is Fibonacci is one of the most accurate tools that you'll use. And it's actually one of the simplest ones to use as well. The reason why Fibonacci works so well is because it's what everyone else uses. It's what other retail traders like me, you, and everyone else watching this video uses. And it's also what the banks, institutions, and professional investors use as well. So when everyone is using this tool to figure out where price is going, that's what makes it so accurate, because everyone is going off based on the same numbers. All right, so the next thing we need to know to do Fibonacci retracements and extensions is what a swing high is and what a swing low is. So a swing high is created when a high is higher than any other surrounding price. And a swing low is created when a low is lower than any other surrounding price. So pretty straightforward. Swing high is just the ultimate high and the swing low is the ultimate low. So here's an example of what that looks like. On the left side, we can see this swing low. Price is lower than it is in any other surrounding area. And then onto the right side where the swing high is, we can see price is higher than it is in any other surrounding price, giving us the swing low and the swing high. So when we're drawing a Fibonacci retracement or an extension, if we're measuring an uptrend like this, we would start the swing low and go up to the swing high. All right. So this is just a description of what we're doing. A Fibonacci retracement is when you take two extreme points, the swing low and the swing high, and divide the vertical distance by the key Fibonacci ratios. Lucky for us, there's tools that are already made on TradingView and MetaTrader 4 that will calculate it for us. So we ourselves do not actually need to know the Fibonacci ratio. All right. So these are the key Fibonacci ratios. You don't need to memorize these. I'm just putting these out here because these are the ones you want to pay attention to. It's built in already. Most of these should already pop up on TradingView when you use it, but these are just the ones that I use personally. So this is what it looks like. I color coordinate to make it a little easier. This is not exactly what it's going to look like if you draw it yourself, but you can see starting on the left side, we start from the swing low, up onto the right side, it ends the swing high. So that's where we draw it with. And we can see that the lines are drawn right here. We have the 382, 550, 618, 786, 886, and then the 100% retracement. So this is what we're going to be looking at. These are what the levels look at. Let's dive into what downtrend looks like. So downtrend is the exact same thing, except we start from the swing high and draw down to the swing low. So the main difference is here. Uptrend, we start from the swing low to swing high. Downtrend, we go from the swing high to the swing low. And that's all it really is. And don't worry, at the end of this video, I'll show you how to draw one on an actual chart. All right. So there are some terms to know. Impulse means with the trend and correction means against the trend. So all that means is if I say impulse, all that means is a movement that's going with the trend. And when I say correction, that means a movement that's going against the trend. So there are some behaviors to take note of, and this is how we actually make money using the Fibonacci retracements. If the impulse is slow, the correction is typically also slow. While on the other hand, if the impulse is fast, the correction in general will also be fast. If the impulse is sharp, the correction will be shallow. So what I mean by that is the impulse is explosive. If the impulse was a wide price movement, that means the correction will be a shallow price movement. It won't be as intense as the impulse. So let me bring up an example of what I mean by that. So here we can see, if we start on the left side, we're measuring this uptrend right here. You see a fast, deep impulse shoot up, and then we see a fast, shallow correction go straight down. And if we look closely, right, the second text bubble, we can see price touches exactly, the 382 retracement before returning into the uptrend. Then we move on to the right side of the screen, measuring that downtrend. We see another fast, deep impulse. Then we see a fast, shallow correction. And again, if we look at the last fourth text bubble at the end, we can see price again touch the 382 retracement level perfectly, giving us that shallow correction. All right, so now let's move on to Fibonacci extensions. So Fibonacci extensions, we use the exact same tool, and we use the exact same theories, exact same everything. So a Fibonacci extension is simply used to predict spaces of resistance and support in the market, just like the retracements. So let's go over the differences between the two to clear the air. Once price breaks the 100% retracement level, you are now measuring in extensions. Common Fibonacci extension levels are 1382, 1618, 200, 2382, etc. Again, you don't have to memorize these. The tool itself will already have these on there. These are just the ones that I use personally. So now let's bring up an example of this. Again, if we see on the left side, we start the swing high, we draw down to the swing low, price moves up, breaks the 100% retracement level, and reaches the 1618 retracement level all the way at the top before returning down. So we could have used this as either a take profit or an entry for a sell. Here's another example. We started the swing low, we draw to the swing high. We can see that price then broke the 100% retracement level, going perfectly to the 1382 retracement level before going up. Again, perfect use of a support or resistance band. Very, very simple to use and very accurate. So now let's move on to harmonic patterns. So harmonic patterns are, I like to call it the price action tonic, because it just gets the job done very fast. It makes it so that you can make your trades from somewhat accurate to very accurate with just adding one thing. So what exactly is a harmonic pattern? They are geometric price patterns using Fibonacci ratios to determine price turning points. So in simple terms, it's giving us an area where price is likely going to reverse. It sounds difficult and scary, a Y100 in my bed and quit Forex. I know what you're thinking, but it's actually pretty simple. If you can remember four numbers, you're capable of using harmonic patterns. Like I say over and over and over, Forex is a bunch of simple things put together into something that looks complicated. So let's just get straight into it. So I'm only going to go over two patterns because I want to keep it simple. I don't want to waste your time with stuff that you're not going to absorb right now. So the first pattern we're going to look at is called the ABCD pattern, or the AB equals CD pattern. Reason why it's called that is because the AB ratio is equal to the CD ratio. So this is what they look like. It looks like a diamond shape. Take note of how it looks symmetrical. And that's actually one of the key aspects of this pattern. If it's not symmetrical, it's not valid. So all we're doing is memorizing these two retracement levels. So first rule is AC must be between 618 and 786. So AC is just the retracement from A to B. Rule 2 is BD must be between 127 and 1618. So AC is measuring the retracement and BD is measuring the extension. So all this pattern is one retracement and one extension. The third rule is AB and CD must have a 1-to-1 ratio, hence the name AB equals CD. So if you can see that AC has the right ratio, BD has the right ratio, and they match up in a 1-to-1 ratio, you have yourself a valid ABCD pattern and a valid trade to enter. So here's an example on a live chart. We can see that AC is within 1618 to 786. You might see it says 601, that's a little lower. but it's within range. You know, we don't want to be too nitpicky. We want to be nitpicky enough, but we don't want to be nitpicky to the point where we never find a trade. And we can also see that they're the same ratio, again, that 1-to-1 ratio. We can see that BD is between 127 and 1618. And we can also see if we bought right at the bottom of the pattern, we would have made some money because then price went up. We could have bought a new house, a new car, a new whatever. All right, but that's basically it for the ABCD pattern. If you recognize the 1-to-1 ratio, you recognize the correct retracement extension, enter yourself a buy, enter yourself a sell, and you're gonna make some good money off of it. So the second and final pattern we're gonna go over is called the Gartley pattern. This is what it looks like. It doesn't look like much, but let's get into the ratios. So this one, you need to remember 4 ratios. The ABCD pattern, you only need 2 ratios. This one, you need 4 ratios. And don't worry, you can find all these online. I highly recommend you go and Google Harmonics. That's what I use to look at my harmonics. It's a great list of every harmonic pattern there is that you want to use. And I also use a harmonic scanner to find them for me. If you're interested about that, drop a comment down below and I'll send you the information about that. So anyway, the first ratio we want to know is the X to B pattern. We want it around 618. XD, which we want 786. Then we want AC, which is 382 or 886. Then the final one's BD, 1272, 1618. And again, guys, you don't have to memorize these. I don't have them memorized myself. I have my trusty notebook always by my side, or I have Harmonics by my side. So if I see potential pattern on the chart, I can just go compare it to my notes. So here is a Gartley pattern that I actually traded off of. This looks really crazy because this is an old screenshot that I actually took a trade off of. So we can see right at the top of the pattern, price dropped, and then we could take a sell opportunity on that. And then we have another example right here. I see a Gartley pattern right at the end of the Gartley pattern, price dropped pretty heavily. So that's it for the Gartley pattern. I'm going to briefly now go over how to draw these on TradingView. I'll see you guys on TradingView. All right, so now we're on TradingView. So I'm going to show you how to draw the Fibonacci extension retracement tool using TradingView. So I'm on EURUSD. I want to measure the retracement of this downward impulse right here. I want to figure out how high price is potentially retracing up here. So I'm going to go over to the toolbar right here. We're going to see the pitchfork tool right here. Click the arrow right next to it. Go down to Fibonacci retracement right here. We're going to select that. Now, since we're measuring a downtrend, we're going to start the swing high right here and go down to the swing low. So I'm going to click right here, drag it down to here, and boom. So now we have the key Fibonacci ratios up here. So we can see that it already passed at 236, which means retracement has officially begun. And then we can see 382s right here. So essentially what I'm seeing right here is that EURUSD could go anywhere safely between here to here, because these two right here are what the most common retracement levels. And especially since this is a pretty fast downward movement, I'm more certain I'll see price go up to 618 more so than 786 or 886. So let me draw another example. In fact, let me draw you an extension. And I actually see an extension right here. So I'm going to measure this movement right here. And I'm going to show you how we could see the extension right down here. So I'm drawing from this swing low up to the swing high right here. Boom, just like that. And we can see right here, price broke the 100% retracement and touched the first extension, the 113, before bouncing up. So we can see that using the Fibonacci retracement extensions, using the same thing, the same tool, just giving us different support and resistance levels. So that's basically it for this video, guys. Thank you for watching, and I'll see you in the next one.